Now, as far as where we are today with quantitative analysis and things like that, not all quants are traders, okay? And not all traders are quants. But the majority of quants are not traders. They're just these, bright young men and women who have advanced degrees in mathematics and robotics and applied sciences and physics, and they come on and they program these things and write these wonderful codes, and they have the ability to test everyone's imaginations and ideas about different markets and securities, and they write code for it, and then voila, now you have the next mutual fund or the next hedge fund. And what you don't know is that a lot of these mutual funds and hedge funds, especially the ones back in the early 90s, they ran multiple programs at once, simultaneously. The reason for that is if program A did well for 6 months and then started to break down, they could have them get rid of program A and then bring in and introduce program B, and then put all their people into program B, and they just kept recycling and redoing these programs. And then they start being able to take advantage of loopholes in the prospectus law. And with a prospectus, you have to put down all the ins and outs about the the strategy that you're using. Well, they were able to get around that, the 2-year history, the 5-year and 10-year stuff like that, because obviously a new fund doesn't have a 5 and 10-year history, but they were able to incorporate the best performance of the older fund and incorporate that into the new fund, and by using similar names or changing the names, they're able to put that in there, and then thus you thought that this fund had this extraordinary track record, and it didn't. I could go into a lot of detail about that too, but I'll just say this. If some of you who have your old prospectuses, pull them out and actually read them, and you'll see what I'm talking about. You would be blown away. There was a lot of cheating with that and lying, and that's why fund managers, these companies they change fund managers like they were changing underwear. So anyway, everyone was looking for the biggest and the brightest guy, and a lot of the best managers would play musical chairs and things like that. Now, a lot of them made money not by actually buying and selling in the market, but by cheating. All right, let me break it down for you what I mean by cheating. In a bull market, you've already heard me say that everyone's a winner in a bull market because everyone's just buying stocks. They're just buying. Anything that is in a raging bull market is being bought. I could hire monkeys or octopuses or skunks or rabbits to sit here and pick and just roll out the Wall Street Journal and have them run across it, whatever their footprint hit on whatever stock it was, put money in it, and I would make money. In the 90s, that's how it went. The go-go 90s. It was a raging bull market. You could buy the breakouts, you could buy dips, you could just buy. You could just literally buy the close of every day and make money. I don't remember hearing about anyone losing money in the 90s. So everyone thought they were a genius in the 90s. Everyone was a trader in the 90s. You had all these trading rooms and trading shops and, office suites. You could just walk in off the street, open up an account, and sit right here in a room full of 50 or 100 people and trade and feel like you're part of a community. That's a whole nother video series. I just want to bring home the point that in a raging bull market, everyone makes money. So everyone thought they were smart in the 90s. So you had all these big shot money managers and hedge funds taking off and things like that. And then when the bubble bursted between 1999 and 2000, when the bubble bursted and everything started to collapse, you saw these funds going away. People started taking their money out. And it wasn't long before that 9/11 rolled around, and then the market took another punishing blow. So you've always had these ebbs and flows, booms and busts, things like that. And when everything is bullish, I don't care what the market is, whether it be gold, silver, the S&P 500, the Dow, JDS Uniphase, Yahoo, Google, I don't care what it is. If it's in a raging bull market upcycle, everyone's going to make money with it. But as soon as it crashes, then everyone wants to blame the broker or someone else for pushing that or touting that security on them. And they say, I was ignorant, I didn't know, pay me reparations. That's a whole other video too. But you do need to know this too. When these big wirehouse firms on Wall Street were pushing these different securities and things like that, they already knew that a lot of these would blow up in people's face because that's what they were designed to do. So they would set aside a large amount of the money that they took in to pay for those lawsuits because they knew that the SEC would hit them with fines. So they had a fund set aside for this, and they did this for years. They know about this. So that's why recently when you hear Goldman Sachs gets hit with a $500 million fine, that's just lunch money. That's nothing. That's only a fraction of the money that they actually set aside for that lawsuit. They plan their lawsuits around their initial public offerings, around their different securities that they create, okay? So the bottom line is not every quant is a quack, but the majority of quants are quacks. Not every quant is a trader. The majority of quants are not traders. However, some traders are quants. Okay. Now we've established that. So it brings us back to our original question. If you're being told in mainstream media that there's no one in the market except for the big bad algorithm, who designed the algorithm? The quant. What you need to ask yourself a question is that the quant who designed the algorithm is the quant a trader or just some dude out of an Ivy League school? That's where the real issue comes into play. That's the real question you need to ask yourself. Now, does it really matter? Not really. And here's why. The high-frequency trading, the dark pools and all that stuff, they were never designed for the retail guy in the first place. They were designed for the big institutions so that they could hide what they're doing. And so that they could help them kind of manipulate and cheat a little bit more. Okay? Now, what I mean by cheating, I mean by manipulating order flow. Okay? As you see right here on the right-hand side of the screen, you see this here is the price that the security is trading at. This is a chart of the eMini S&P 500, one of the most liquid and highly traded vehicles on the planet. And you can see here on the ask side, this is you got 794 orders at this price, and then you have 872 orders at this price. So for every buyer there is a seller, these orders are matched up evenly. Okay, that's how you get fills. Okay, that's how this market works. What you see is a lot of ghosting nowadays because of the high frequency trading, where let's say this 512 could be a real number or a fake number, and then all of a sudden, right seconds before the price gets there, those orders disappear, and instead of being matched and routed and cleared, they just vanish from the system. Now, technically speaking, if you're a market maker, that is illegal. You can't put fake prices in like that. A retail guy or a normal person, you have a right to change your mind. That is not illegal. I have a right to change my mind. I can put an order right now to sell 1 million of these contracts at this price, and then 2 seconds later I say, I changed my mind, and I can delete that. That's perfectly legal. There's nothing wrong with that. That's called buying and selling. I can change my mind. I can do that. But how it comes into cheating is that market makers move the market. They provide liquidity in the market, and they set price. So it's illegal for them to play around with pricing and do things like that. Now, the high-frequency traders and the dark pools and stuff, they get preferential treatment because they pay a premium for it from the exchanges that allow them to work in darkness. You know, it's very difficult for an elephant to hide in a room. So if you want to dump 10 million shares of something, well, you don't just come in here and just click this button right here and say sell 10 million, because then you would collapse this particular market and you'll be trading against yourself. But what the dark pool will allow you to do is break this 10 million share thing down into increments that you can do on a high frequency level, and it can break it down at different price levels and stuff, and put it in different exchanges, going through different pools and order matching and routing systems, and then get you your 10 million share without even really moving the price that much. Does that make sense to you? All right, that's how they do it. Does that really bother you? No, it doesn't bother you. I can still sit here and day trade and scalp all day long and still eat most people's lunch. High frequency trading has nothing to do with you. It's just a mythical creature designed to blame someone for other people's lack of being able to extract money in the market. Losers lose. They lose all the time, and they have to find a different scapegoat and a different person to blame. It just what happens to the people who are getting the blame for the high frequency trading right now are really criminals. And they've really done things and are doing things, other things that are a lot worse than high frequency trading. High frequency trading does not crash markets. People do. The powers that be do. All right? Now, I'll leave it at that. All right? I'm going to stop this here. And we'll get into some other things later. I just wanted to bring home high frequency trading, how it does not have anything to do with what's going on in the market today. As a matter of fact, let me end it with this. It's easier to make money in the market today than it's ever been in the last 15 years. I kid you not. This is the easiest markets I've ever seen in my life. Sit here and pimp them all day long. It is easy. You have not seen volatility, dude. Volatility was 1999 and 2000 when the NASDAQ had an average daily range of more than 200 points, man. When's the last time you seen the NASDAQ move 200 points? When's the last time you seen the S&P 500 move 110 points in a day? Dude, you have no idea. Back in 2000, between January, March, and April of 2000, when Mr. Alan Greenspan was the Fed chairman, he would routinely come in without announcement and without warning in between Fed meetings, and he would lower or raise interest rates at a whim without warning and drop you right in the middle of the trading day. You talk about volatility, the Dow would move 600 points in 2 seconds. You heard, I'm not embellishing, 600 points in 2 seconds. Then again, it could have been 1.5 seconds. It was just so fast. And it would do this a lot. From January to March, it would happen constantly. They kept lowering rates. All right. When they did that, 600 point movement in the NASDAQ, 600 point movement in the Dow, 110 point movement in the S&P 500. That was a daily routine, dude. Seconds it took to do that. Seconds, not minutes, not moments. Seconds. It will made the 6 look like a walk in the park. Yeah, the Dow fell 1,000 points on May the 6th, but it did it over time. It didn't do it in 6 seconds. It didn't do it in 2 seconds. It did in 2000. So, in the go-go 90s, the markets were extraordinarily volatile. They were explosive, and there was nothing to compare to that, except for 2008. In 2008, we saw something else happen. In 2008, we saw a big problem where they started to let down the guard, so to speak, where they purposely turned off the circuit breakers, where they purposely pretended like they didn't exist. Position limits didn't exist. The markets have always had circuit breakers and always had position limits. So when you hear them talking in the mainstream media and in Congress and Capitol Hill, talking about, oh, we need to institute position limits and all this other stuff, that's all for you. That's for your sake and your purpose, because they're assuming that the general public is ignorant and doesn't know anything, and they're trying to scare people to death. And that's all this is about, fear mongering. All right, the markets are not volatile. They haven't been volatile for a very long time, but at the drop of a dime, they can make it volatile. That's my whole point. So the future commodity futures markets have always had position limits so that no one can corner the market. I say that again. They've always had position limits so that no one can control and corner the market. If you don't believe me, you don't have to take my word for it. Go to Chicago Board of Trade's website. Go to the Chicago Mercantile Exchange's website. Look at any of them. The Merc doesn't matter. And scroll through there and take a look at the commodity contracts, the position sizes and all that, and look at the limits. You'll also find that in the commodity futures markets, they have limit moves and lock limit moves, meaning that once it trades to a certain percentage in a day, the market's locked. It won't move anymore in that direction into the next trading day. And then the next day, it can gap up and lock limit again. Back in the 70s, the lumber market was famous for going lock limit for weeks at a time. All right, so these things are not new. There's nothing new under the sun, man. And these things, one thing has nothing to do with the other. It doesn't hurt you one way or another. I just want to encourage everybody. So let's stop playing this Let's Scare Jessica to Death movie over and over again, all right? There's nothing to be afraid of here, ladies and gentlemen. Just money on the table. And you need to start asking yourself this final question. Why are they trying to keep people out of the market? For decades, Wall Street has always tried to attract people into the market. But now they're trying to scare people away from the market. Why is that? We'll cover that in another video. Until then, peace out.